Katherine, the Mag 7 still are a very weighty part of the S&P, probably over 25%. But you say they're no longer the only game in town. Why not?
Yeah, well, the Mag 7 are 1/3 of the S&P 500 weight. They're going to continue to lead. But what I think is interesting, if you look at the current earnings season, while the Mag 7 are driving earnings, this quarter, the gap between the Mag 7 and the non-Mag 7 is actually the narrowest we've seen. And of everything else, we've actually seen the highest earnings growth in years. So what I think the market is telling us with all the risk factors, with tariffs, consumer, is that you're going to see more divergence. And it's time to look beyond the Mag 7, both down in market cap in the US and outside the US.
How far down in market cap? Does that include the small caps? Because we really have yet to see the rotation into the smaller members of the market, even though people keep saying it's going to happen.
Yeah, small caps are probably the most unloved asset class, which is why I love them. I think they're probably the most dislocated part of the market. Earnings are great, profitability is great, but valuations and sentiment are really weak. So what do we need to happen? We need positive sentiment, health around the US economy. That is our base view. Secondly, the Fed cutting in September could be an elixir. And third, the capital markets activity picking up with M&A and IPOs could set us up well for potentially the next several years.
Perhaps one of the biggest surprises of 2025 to date has been the outperformance of foreign stocks, European stocks, emerging market stocks. Will this continue heading into the end of the year?
I think this is a long-term structural shift. I mean, candidly, I think this is a paradigm shift. Year to date, international developed equities are up 20%. What's changed now is this pretty substantial policy coming through Germany. We're starting to see it come through privates. And talking to companies locally, they really haven't started yet to see that real impact. It's probably going to start in 2026 for the next decade. And that's happening at a time when valuations are really low. So now is a good time to right size that underweight to international companies.
And a lot of investors are looking at India nowadays. It's a very quick moving economy. However, there's lots of talk about the tariffs and how that's going to impact the trade relationship between the United States and India.
Yeah, so that's a real risk. But even when you bake in, they call it, let's say, worst case scenario, let's call that, less than 1 percentage point hit to GDP. All in, India still offers you extraordinary growth in a very low growing world. Plus, it's very lowly correlated. The majority of India's GDP and economy is very domestically driven. So that combination of high growth with low correlations is something that makes it a nice kind of mix in terms of your portfolio construction.
All right, finally, we've been around the world, so let's come back. How are you accessing a lot of these themes over at Goldman Sachs? Is it through active ETFs? Is it through good old-fashioned mutual funds? How are you getting into these plays?
Yes, at Goldman Sachs Asset Management, we have an incredible fundamental equity platform. We manage well over 100 billion in AUM and really have leadership in a variety of platforms, whether it's in India, whether it's in technology, whether it's in our international developed solutions. So we really have a way of developing unique portfolios from the bottom up that have great risk-adjusted results as well.
All right, well, thanks for coming on and talking about it.
Great. Thanks, Greg. Great to be here.